Hi everyone, I'm Andy, and this is the AI Breakdown. Welcome to your weekly news edition, where I'll cover what happened in AI last week, why it matters, all in less than 10 minutes. Let's start with something that, honestly, I really like the look of. OpenAI and DoorDash have teamed up for what they're calling the Small Business AI Jam, a series of hands-on workshops for more than 1,000 small business owners across 5 US cities: San Francisco, New York, Houston, Detroit, and Miami. Instead of another glossy launch video, they're literally putting mentors in a room with people who run restaurants, retail shops, legal practices, accounting firms, and helping them build at least one AI tool they can actually use the next day. We're talking really practical stuff: drafting better marketing copy, sorting inventory, automating staff scheduling, writing those menu descriptions you've been putting off. DoorDash's Elizabeth Jarvis Sheen summed it up nicely. Running a small business is brutal. AI can't make it easy, but it should make it easier. And Chris Lehane from OpenAI calls small businesses the building blocks of a healthy neighborhood, and says if you put powerful AI tools in their hands, you help them punch above their weight and get their fair piece of the economic pie. For me, this is AI moving from keynote slides to Main Street. If you're a SaaS founder, it's also a bit of a tell. OpenAI is seeding usage and expectations at the very edge of the market. The next wave of customers you sell to may already have AI baked into how they write emails, manage bookings, or talk to customers, because they built those workflows in a workshop like this. The big question is whether there's follow-through. A day of training is brilliant, but these businesses will need support, guardrails, and in some cases hand-holding to keep those tools useful and safe. Still, as a signal of where AI is going. Now, zooming out from small businesses to the absolute giants. Over the past few weeks, the big US tech and cloud players have gone on a borrowing spree. Reuters tallies nearly $90 billion in new bonds aimed largely at AI and cloud infrastructure. Alphabet raised about $25 billion, Meta $30 billion, Oracle $18 billion, Amazon $15 billion, with others like Verizon and Salesforce also piling in. Traditionally, these firms have funded growth from their own cash or equity. The fact they're now leaning this hard on public debt is a pretty loud signal. Building AI-ready data centers, buying GPUs, wiring up new regions, it's all very capital intensive. On the plus side, if you're building SaaS or internal tools, this is good news. It means the cloud providers are not quietly cooling on AI, they're doubling down. Expect more capacity, new AI-specific services, and probably aggressive discounts to lock you into their stacks. For me, this doesn't scream that the AI bubble is bursting. It says we are all in on AI and we'll worry about the bill later. Great for innovation in the short term, but if you're building on top of these platforms, keep an eye on long-term cost exposure. Cheap GPU time today doesn't guarantee cheap GPU time in 3 years. Speaking of infrastructure, Nvidia just gave the market a fresh data point. Their latest quarterly results came out this week, and they smashed expectations again. Roughly 66% year-on-year sales growth, with about 2/3 of their revenue now coming from data center chips. The stock jumped several percent on the news before settling back. CEO Jensen Huang used the earnings call to swat away all the AI bubble chatter. His line was that from their vantage point, what they're seeing in orders and deployments looks very different to a fad that's about to pop. Why should you care if you're not trading Nvidia stock? Because Nvidia is effectively the heartbeat of enterprise AI build-out. When their data center business is on fire, it means cloud providers and big enterprises are still pouring money into GPUs for training and running models. For anyone building AI products, that's a quiet reassurance that the underlying platform is still expanding. More clusters, more capacity, more incentive for clouds to differentiate with better tooling. I'd still treat it as cautious optimism. One strong quarter and a relieved stock market don't cancel out the broader questions about whether all this capex turns into sustainable revenue. But if you were worried that the AI party was about to be shut down by investors, think again. Moving on to financial services, Model ML, a startup based in San Francisco with offices in New York and London, has just raised $75 million to automate a big chunk of what junior investment bankers do. Their tools use generative AI to draft pitch decks, spin up financial models, and crank through due diligence reports. Basically, a lot of the classic analyst grunt work. Investors in the round include FT Partners, QED, and Y Combinator, which is a serious fintech vote of confidence. Remember, this company is only about a year old and had already raised $12 million earlier in 2025. If they pull it off, deal teams could move much faster. Imagine turning round an M&A pitch in days instead of weeks, because the first pass on the deck, the comps, and even parts of the model are drafted by AI. But you can also see why junior bankers are feeling twitchy. The stated mission is to replace much of the grunt work done by investment bankers. For partners, that sounds like efficiency. If you're the grad who thought you'd spend 3 years in Excel, it sounds like your apprenticeship route is being rewritten in real time. This is a strong domain where AI could land: repeatable documents, data-heavy slides, templated analysis. The banks that get this right free up humans for client conversations and complex judgment calls. The ones that just use it to cut headcount without rethinking workflows are storing up risk because someone still has to own the quality of the output. Back to the UK now, with a story that puts some real numbers on AI productivity. Reuters profiled London accountancy firm Moore Kingston Smith, which uses a platform based on Google's Gemini 2.5. One team cut a fraud check report from around 2 weeks down to 2 hours by letting clients upload entire datasets for automated analysis. For an accounting practice, that's not a small tweak. That's a different operating model. Faster client reporting, less backlog, more time for actual advice instead of wrestling with documents. Zoom this out to the wider services economy, law firms, consultants, corporate finance teams, and you start to see why the UK government is betting on AI to help reboot productivity. If the average knowledge worker can claw back even a fraction of that time, it changes margins and capacity. Of course, there are the usual caveats. Over-reliance on AI output without proper checking is a real risk, and staff understandably worry about what this does to jobs in the medium term. But as a concrete, present-day example, it's powerful. AI isn't just a lab toy, it's quietly shortening month-end from a slog to something manageable. Speaking of the UK, there was also a big political move this week. The UK government has set out plans for multi-billion-pound AI investment and the creation of AI growth zones, regional hubs tied to big data center and skills projects, with a heavy emphasis on AI skills and SME support. The idea is to turn these areas into proper ecosystems: universities, startups, big tech partners like Microsoft and Google, all working together, and to get thousands of people trained up with AI skills. There's also specific support earmarked for small and medium enterprises to buy tools and get advice on adoption. If you're running a company in or near one of these zones, this is worth watching closely. It could mean grants for pilots, subsidized cloud credits, or just a better pipeline of AI literate talent coming out of local programs. The mood in the UK business community is optimistic. People like the direction, especially the focus on skills and mid-sized firms. But there's healthy skepticism around execution. We've heard big AI funding numbers before. The real test is whether money actually reaches frontline teams rather than disappearing into consultancy slide decks. Still, as a signal, it's clear. The UK wants to be seen as an AI-friendly economy, and that can only help if you're trying to sell AI-enabled products into that market. From governments to the big cloud platforms again, this time Amazon. Reuters reported on an internal memo telling Amazon software engineers to use the company's own AI coding assistant Cairo instead of third-party tools. Cairo launched back in July and does the usual code completion and generation tricks, but the key line in the memo was essentially, we're not planning to support any more external AI development tools. So if you're an Amazon engineer happily using an external model for coding help, the writing's on the wall. You're expected to move to Cairo. This is part productivity play, part strategic control. By funneling all that internal usage through their own assistant, Amazon gets more data to improve Cairo, keeps sensitive code away from rival ecosystems, and strengthens its own AI stack for AWS customers down the line. Developers, unsurprisingly, have mixed feelings. On places like Hacker News and Reddit, some people see it as a classic big company strong-arm move that could force teams onto a tool that, today, might not be as good as the competition. Others shrug and say, look, of course Amazon wants Amazon engineers using Amazon tools. The bigger pattern is that large tech firms are starting to insist on proprietary AI inside their walls. That's all for this week's AI Roundup. If you found value in this breakdown, please leave a rating and hit subscribe. See you next week.